Hey everyone, we got some big news for Lucid stock investors today as the company reported worse than expected production and delivery numbers. So in this video, I'm going to review those production and delivery numbers and why the stock reacted poorly to the news coming out today. The stock is down 4% as of this recording. So let's jump right in. Let's see what these figures mean.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Lucid today announced that it produced 2,391 vehicles in the fourth quarter and delivered 1,734 vehicles during that time. Now, the news on production was not the bad news today. The company produced on the higher end of what investors were expecting, but the bad news came from the delivery number. Only 1,734 out of the 2,391 were delivered, leaving more than 600 of these units in inventory. Now, I'm going to share with you already the inventory that's rising and the totals and the differences for the year. And that further plays along with that investor concern with Lucid, which is customer demand is not that strong. The company has capacity. They could produce much more vehicles. In fact, they've had to lower vehicle production numbers twice this year. And so they could have produced more, but they had to produce less because customer demand was not that strong. For the full year in 2023, the company produced 8,428 vehicles and they delivered 6,001 vehicles, leaving a gap of 2,400 in inventory. Now, this is below. To begin, the company had made estimations for 2023 that they were going to produce somewhere around 12,000 units. Then they lowered that production target to 10,000 units, and then they lowered it to between 8,000 and 8,500 units, and they completed the year with 8,428 on the higher end of their most recent guidance given. So the disappointment here from Lucid is that they've lowered their target several times. They hit the target, but they didn't deliver all the vehicles that they were expecting to deliver, even after lowering their production target. Management said they were prudently lowering their production target to better match customer demand. And given this spread between deliveries and production, it may have been necessary to decrease production even more to match with customer demand, because that's how lagging customer demand has been for Lucid's vehicles. So as of September 30th, 2023, the company had 798.9 million of inventory. That was down from 834 million as of December 31st, 2022. But given the difference between production and deliveries here in the fourth quarter, I wouldn't be surprised if this inventory total were to increase. Now, yes, units of inventory were increasing, but the company has been taking write-downs on its inventory because they haven't been able to sell as many as they thought at the prices they thought. So they've taken write-downs throughout 2023 on their inventory value. So even though this inventory of 798 million is lower than the 834 million, that doesn't necessarily mean they have less units in inventory. This just means that they have less total value in their inventory right now, which is a result of partly the write-downs that the company is undertaking throughout the year as they've lowered prices to try and sell more units, which has been met with mixed success here in 2023. So these, even though we're in 2024, these numbers that we're getting are still 2023 numbers. We won't get 2024 numbers until several more months into the future. So I highlighted that the stock is down 4.25%. As of this recording, it was down as much as 8% earlier in the day when the news came out. It's rebounded somewhat and it's down only 4.25% as of this recording. Another thing that investors are concerned with Lucid is the shareholder dilution, the average shares outstanding. The number of shares outstanding is an important financial metric. If a company issues more stock because it is running out of money or it wants to invest in a new growth project, it has the potential to decrease your earnings per share. Look up here, when I have a net income of 1,000 and shares outstanding of 100, my earnings per share is 10. You take the net income divided by shares outstanding and you get 10. But now let's say you increase your shares outstanding to 200 and you have the same net income of 1,000. Now your earnings per share is just 5. The same is true in the opposite direction. If a company is losing money on the bottom line and it issues more shares, it spreads out the losses across more shares, thereby reducing the loss per share, which is a tricky way to reduce the loss per share. Look at this point here. A net loss of 1,000 with 100 shares outstanding creates a loss per share of 10. But if you take that same net loss of 1,000 and you spread it across more shares, 200 shares, you now have a net loss per share of just 5. So it's a tricky accounting trick to get your losses reduced on earnings per share. So you want to take a closer look to see where the improvement in the loss per share is coming from. That being said, you can see Lucid has increased shares outstanding from around 1.7 billion all the way up to $2.28 billion. And given their losses on the bottom line, I wouldn't be surprised if Lucid Group continues to dilute shareholders. And even following their recent price declines, Lucid stock price is not cheap. Looking at the price to sales ratio, the price to sales ratio measures what you are getting for the price you are paying in terms of sales. So what are you getting for every dollar in sales that you're paying? For example, in this first example, the market capitalization is $1.25 billion and the sales for the previous 12 months were 185 million. That means you're paying a price to sales of 6.76. Similarly, if you look at the expected next year revenue, you would be paying $1.25 billion for 465 million in revenue expected, and that would mean the forward price to sales ratio is 2.69. The factors that influence the price to sales ratio include profitability. Of course, you would be willing to pay a higher price for a company that generates higher profits. That means $100 in sales will turn into $20 in net income for a company that has a 20% net profit margin. That same $100 in sales will only turn into $5 in net income for a company that has a 5% net profit margin. So companies with higher net profit margins tend to sell for higher price to sales ratios, all else being equal. Another thing that influences the price to sales ratio are growth rate expectations. All else being equal, companies that are expected to grow at a faster rate sell for higher price to sales ratios. Similarly, higher total addressable market opportunities tend to result in higher price to sales ratio because investors see this company being able to grow for a longer period of time before hitting the ceiling. And finally, cyclicality. Companies that are more stable and less cyclical tend to sell for a higher price to sales ratio because cyclical companies are seen as being more risky. Companies like McDonald's are seen as being non-cyclical. McDonald's does relatively well whether the economy is booming or whether the economy is in recession. And so investors would be willing to pay higher price to sales ratios for companies that are less cyclical. Investors use the price to sales ratio when a company has negative earnings, unstable earnings that fluctuate between positive and negative, and also the same for cash flow. If a company has negative cash flow or cash flow that's fluctuating from positive to negative, the price to free cash flow and price to earnings ratio are less informative, so analysts use the price to sales ratio. That being said, you can see that the price to sales ratio of 9.110 is the lowest that it's been going back 1 year, but a price to sales of 9.1 is expensive, especially for a company that's making little progress in improving profitability, little progress on growth, and so investors are concerned about Lucid Group. The good news is that 2024 is shaping to be a better year for Lucid. They have newer models coming out that seems to have stronger demand. Hopefully they can use that to increase deliveries, increase production, reach better economies in scale, and make better progress on profitability. That's the widely accepted consensus around Lucid stock, that it is actually going to achieve those better results in 2024 and then again in 2025. So yes, 2023 was a difficult year for Lucid Group, but it's shaping to be a better one in 2024 and then an even better year in 2025. Thank you for watching this video. I truly appreciate it. I know there's a lot you could be doing with your time and a lot of other videos you could be watching. So I truly appreciate that you chose to watch this one. If you want to see more videos just like this, hit the subscribe or the like button. They'll both help me make more videos just like this one. Thank you again.